You're welcome to week 7 of our Forex Trading School, and in this week, we'll be looking at three important lessons. I wanted to jump them and move into analysis proper, but at the same time, I said it's important that I get this to your knowledge so that you'll be completely aware of the industry you are in and how it works. And also, part of this lesson that I'm about to teach you is going to help you to determine the kind of trader you will become depending or considering your kind of personality or the kind of work you engage in or what simply would work best for you. Every trader out there is not doing the same thing. And I do not counsel you to do what anybody is doing. You need to understand yourself, understand your schedule before you can jump into this business to make sure that the path you've taken is what is convenient for you. Okay, this is lesson 1 of week 7, and in this lesson I'm going to be discussing two things quickly. The first one being the 4 types of traders that we have. Now these 4 types of traders, the one that you choose to become determines the kind of trading you will do or the kind of strategy you will adopt or the time frame you will be trading on. So the first one is that we have what we call the scalpers. We have the scalpers. And the scalpers are simply traders who take advantage of very small movement in the market. For instance, if gold is moving from 2001, this is the current price of gold, and they intend to buy, that is scalpers intend to buy, and this market went to their favor. The moment market moved to even 2001.90, they have taken their profit, or 2001 to 2002 or 2003, they take their profit. Scalpers are more like traders who have the time. They have the time to monitor the market. If you are somebody who is very busy and you have other things doing, you can think of becoming a scalper. Scalpers are people who have the time to watch at all times because they take their profit in seconds, in minutes, 5 minutes. You can see them say, buy at 2000, you will see TP1, TP2. Always watch these things. Maybe if you're in a Telegram group or WhatsApp group, you will see them say, take profit at 2001, the next profit 2002, the next profit 2003. This is something scalpers do because they have the time to watch. If you have other things doing, you may not want to be this kind of trader. You may not want to scalp. Another thing you need to understand is that if you are trading with the sole purpose to make trading a full-time business, then scalping might be something you may consider. I'm going to tell you generally what I recommend at the end, but let me explain this because I'm not going to make this choice for you, but I need you to be aware of how these things work. Now, if you are going to be a full-time trader, you may consider scalping, and if you want to do trading as a full-time business, being that trading is going to be your active source of income, you may consider scalping because we have 2 types of income. We have active and passive income. Passive income being something you want to generate money for you in a long time. You want your money to be working for you even while you are sleeping. This financial market can serve both purposes as an active income and also as a passive income. So if you are looking to take Forex as a source of passive income, scalping is not something you should do, and if you are busy, scalping is not something you should do. Also, we have the next kind of trader, which are called day traders. Day traders are also scalpers, but I want to differentiate them because a day trader is somebody who opens a position in a day and closes that position the same day before the next day. They open a position maybe in London session in the morning and they close it that same day. They don't let their trade or position stay overnight. That's why I said you can also categorize scalpers under what? Day traders. But in this time, I want to explain day traders are people who might even take a bigger profit or allow price movement for a bigger time, maybe for 15 minutes or for 4 hours or more than 4 hours. Or they can place a trade, set their TP. So they place trade in a 2000 and then their TP, you will see something like 2005 TP1, TP2, 2010. That is take profit targets. You see that they are expecting something big, something bigger, or a reasonable movement in the price of that asset. They are not in a haste to take their money immediately. But the thing is that every single day before that day ends, they must close all their positions. Being a day trader also makes trading business an active source of income for you. If you know that you want to take trading as a full-time business, then you can consider also becoming a day trader. But if you have, let's say, you're always out there in your shop, or you're always out there in work, you work in the bank, or you teach and you don't have time to watch your phone, then you should not consider being a day trader. Now, let me tell you something important in these two types of trading. Considering a long term, these two kind of traders have a higher risk of losing a larger amount of money than the other two that I'm going to mention, because every day they expose their capital to risk and they are victims of price fluctuations. What do I mean by price fluctuations? Most of the times you don't see the price move like this to give you the normal structure that we know. You can see price, instead of going down, you can see this movement. Let's say this is 4H time frame. Instead of market going all the way down and then going up immediately, market can consolidate or range like this for a day, two, before it finally expands. You see that what these two kinds of traders, they might get confused at a point when market is in a ranging condition. Some will feel like, oh, he's buying now. Some will feel like he's selling now. This is what falling victim of price fluctuations. That is why they are more exposed to risks. As a matter of fact, there is a statistics I told you in one of the classes that said that 90% of retail traders lose 90% of their capital in the first 90 days of their trading. This is usually for this set of people. That statistics may not hold for the last two kinds of traders that I'm going to mention now. Why you choose these things, also understand that these are the downside to becoming this kind of trader, even though you have a chance of making money every single day. We are coming, I'm going to give my counsel at the end, right? And then let's go to the third kind of trader. So the next kind of traders that we have is what we call swing traders. Remember what I told you swing is when we have an uptrend, for instance, and we have this market structure of higher high, higher low, higher high, higher low, higher high. Now, this is the direction of the trend because it's an uptrend. So this movement in the direction of the trend is what we call a swing. Swing traders are traders who allow their trade to stay overnight for days, for weeks, a couple of weeks, or let's say 3 months. Now, this kind of traders are basically people who do not have time to become full-time traders, but trust me, these people, they also make real money from the financial market. As a matter of fact, from my own experience, I would tell you that this category of people make more money than day traders and scalpers. You know why? They expose themselves to a very little risk, and then they allow the market to give everything it has to offer in the situation whereby market went in their direction. And these kind of traders, they place 1 to 2 to 3 trades per month and they allow it to run. They can capture up to 1,000 pips, 2,000 pips, depending on the movement of the market within that month or within that week. Personally, me, I'm a swing trader. I'm not in a haste to take my profit, because I've done both day trading and swing trading, and my spirit is more peaceful being a swing trader, even though I am a full-time trader. Being a swing trader does not mean that you will not earn money every day. It simply means that you are allowing your trades to run over a period of time. You are basically looking at higher time frame targets. For instance, if you are a swing trader and you are trading in monthly time frame, that is, your analysis is in monthly time frame, you are expecting a monthly target. Say the price of gold is currently in 2000, and then you are expecting that the monthly target or the monthly high is going to be at 2070, that is $2070. If you go down to a 4 hours time frame, within this period that you marked out, this is what you will be seeing: higher high, higher low, higher high, higher low, until it gets here. A swing trader places this trade and hold it, and even can add positions each time we have a retracement in lower time frame like daily and weekly. You are adding new positions and trailing stop. There's what we call trailing stop. Before we go into analysis next week, I'm going to teach you this trailing stop. You are moving your stop loss to your entry or moving it above your entry to be capturing money as time goes on. You are holding on from here to here. Sometimes you are in $2,000 profit, for instance, and sometimes when there is retracement, it goes down. But after retracement, market continues going again, your profit keep increasing. One thing that can be demoralizing about swing trading is that today you might see your profit at $2,005 and tomorrow it comes down to $1,700 and you're like, man, I would have taken this. No. It is okay to hold because you know that market is going up and is eventually going to give you, let's say, about 3,000 to 4,000 profit, depending on your risk tolerance. I've taught risk management in our 6th week. Depending on your risk tolerance, you already know that this market is going to give you a bigger profit. You just keep holding on. You need patience and faith to be a swing trader, because you'll be looking at money and you won't take it, because that is your trading system or rule. So as a swing trader, you will have to trade in higher time frames. Your trading analysis have to come from monthly, weekly. You are looking at monthly, weekly targets. But as a day trader and scalper, you are even going down to 5 minutes, 1 minute. Fast scalpers use 1 minute. Day traders, they use 5 minutes targets, 15 minutes targets. All right, but for swing traders, I will counsel that the least target that you should have should be 4 hours time frame, targeting 4 hours zones, or targeting weekly zones or daily zones or monthly zones. So the next and the last type of trader that we're going to be looking at is the position traders. This is where the investors fall into. These people, they can hold trade for 6 months. They can hold their trade positions for 6 months, 1 year, 1 year plus. They are still holding on to their trade. These are basically called investors. Investors in the sense that what they think long term. They are long term traders. While other kind of traders are short term traders. Position traders are, long term traders. These are people that they are big guys. Banks are position traders. Bank can hold a position for 1 year. These big world richest people that we know, they hold their positions for 6 months, 1 year. But before you will be able to become a position trader, of course, you should have something else that is yielding you money such that you can overlook this investment. Situation might not be favorable for you to become a position trader because you are still coming up, and maybe you have just $500 or $100. If you do position trading and you are waiting until 6 months to 1 year before you can take profits, then it might not be convenient for your financial status. Okay, that is it for types of traders. And position traders are traders who want to do trading as a source of passive income. These two, they are a source of passive income. Then the first two, they're just source of active income. All right, let's move to the next point in this lesson 1, which is what? 2 types of trading that we have. We have talked about traders. Quickly, the 2 kinds of trading that we have is, 1, either you are into trend trading, or you are into reversal trading. Trend trading is simply following trend. All you are doing is to catch swing. This is what I mean. This is, let's say, daily. I'm always using 4 hours. Let me use daily now. This is daily, higher high, higher low. A trend trader will do this. You wait for retracement and you place your buy. You follow trend. All you do is follow trend. The reversal trader is always waiting to see when this buy movement will end and market reverses to the downside. What they do is that they place this sell here and then they keep following the market until market is ready to reverse again. They will close, and then when market reverses again, they will place buy again and hold. They are more like swing traders. They will hold until this market is ready to reverse again, depending on the time frame that they are trading. So that is what we mean by reversal. Reversal trading is simply following the market at the point of reversal when a particular trend has ended and another one is about to begin. Let's say at the end of a buy trend or uptrend, you now find a sell opportunity, or at the end of a sell trend, you find a buy opportunity. That is what reversal trading means. But trend trading simply means you are following trend. Each time a retracement completes, you do what? You join the trend. Listen, I did not teach you retracement trading. I do not support you to trade retracement, this pullback or correctional movement. It is very, very risky to trade retracement. I keep sounding this. One of the major reasons or the major ways to lose your money quickly in Forex is to trade retracement. Nobody can accurately predict where retracement is going to end because you are not the one that give these discounts. Retracement simply means discount. You must do what? Follow the trend. Allow them to do the discount they want to do, and when the discount is over, join the trend. All right, so let's move over to lesson 2.